welcome to the Emerson Group Wealth Call for April 2024. My name is Nick Emerson, and I am the owner-operator of the Emerson Group, real estate professionals with an emphasis on income property owners and 1031 exchange strategies to help you defer taxes and continue to build wealth. And today's call, we're going to be talking about how to exchange into a real estate investment trust, or in short, known as a REIT. And I'm joined by Jason McMurtry with 1031 Capital Solutions. And on today's call, we're going to really go through the step-by-step process of how to convert your rental property into a REIT. We're going to talk about why investors would choose this strategy versus the other 1031 exchange strategies available to them in a more traditional sense. We'll go through some of the disadvantages and benefits of using this strategy. And then we'll talk about a quick example of a current real estate investment trust investment opportunity, right?
Sure.
Perfect. So without further ado, Jason, thanks for your time.
Yeah.
And tell us a little about your background and 1031 Capital Solutions.
Yeah, thank you for having me.
Absolutely.
So I founded 1031 Capital Solutions almost 7 years ago, and we're technically financial advisors, but we don't do stocks and bonds and mutual funds and traditional wealth management. We focus exclusively on helping investors do 1031 exchange transactions into a variety of Delaware statutory trust investments. So we're one of the largest providers of Delaware statutory trusts in the country. We have access to all the nationally syndicated Delaware statutory trusts, and we use a consultative and advisory approach to work with our clients. So we'll take time to find out about their specific transaction, the equity and debt that they're dealing with, what's important to them in terms of cash flow or appreciation or diversification, and then we'll recommend a portfolio of one or more DSTs to help them achieve their goals.
And I want to speak to that. That's part of why it was important that I want to get Jason on this call, because what I appreciate about their business model is that it really is a consultative approach to really understand what's the objectives, and not just saying here's a DST, it works for you. It's here's all the options, and here's the ones I think would be the best fit for you based on what we discussed is important to you. And I'm an accredited investor with them. Unfortunately, I just went in there the other day to see what they had. There were 33 different offerings you guys had. So plenty different flavors within that space as well. So getting into the DST and just more of a general format, right? Because we understand you have to use the DST or Delaware Statutory Trust vehicle to get into the exchange. Maybe we just start with what's the basic DST framework?
Sure. A Delaware statutory trust is, at its heart, it's a trust. So like a family trust, if there's a husband and a wife and they create a trust and they go buy a piece of property and they put that property in their trust, and then you go to the county recorder's office to see who owns the property, it's going to say that the trust owns the property.
Right.
But they own the trust, and so they own the property through the trust. Well, a Delaware statutory trust is very much the same thing. It's a grantor trust, and it might allow 100 or 200 people to own an interest in that trust, and then the trust itself owns typically a large commercial property.
Right, so the trust is a framework that allows multiple people to have ownership in a asset or vehicle.
That's
so to
right.
speak. Okay.
Yeah, so this structure was looked at by the IRS 20 years ago, and they issued a revenue ruling stating, yes, this is like-kind property. You can do a 1031 exchange into and out of a Delaware statutory trust.
Okay.
And the reasons people might do this is because they want to sell their property, they want to do a 1031 exchange to defer the taxes, but they don't want to go into another property that they have to manage.
Right.
And so the DST allows them to be a totally passive investor, where they're not dealing with the tenants or the property managers or the loan or any maintenance issues. That's all done by the DST. The investor just becomes a passive investor with the potential for cash flow and appreciation and tax benefits without the operational headaches.
Okay. So we're talking about DST. How do we exchange into a REIT though?
Right. So this creates a lot of confusion because you hear people talking about exchanging into a REIT, and some people rightfully point out that the IRS will not allow you to 1031 exchange into a REIT.
Okay.
And so the step-by-step process is there are some DSTs that as an exit strategy plan to be acquired by a REIT through a tax-deferred 721 exchange. So it's kind of a two-part process.
It's a two-step dance here.
Exactly.
Okay.
Yeah. The first step is to do a 1031 exchange into the DST property.
Right.
And then they'll typically wait at least 2 years to make sure that the IRS doesn't disallow the 1031 exchange. And then sometime after 2 years, the DST gets acquired by a REIT. And when that happens, the investors, through a tax-deferred 721 exchange, end up owning what's technically partnership units of an operating partnership of a REIT.
Okay.
And at that point, their cash flow, their appreciation, their tax benefits, their reporting, all of that is coming from the partnership of this REIT. That's not a taxable exchange.
So the 2-year period with the DST, that's obviously to make sure, right, that you're within, there's no tax implications or issues with the initial exchange from the brick and mortar?
Yeah, the IRS does not like to see people flipping properties, and so they want you to hold it for a period of time. And so
it's a red flag if you're like, hey, we just exchanged a year ago and we're already doing it again.
Yeah, and again,
Okay.
so the industry has kind of used this 24-month marker, this 2-year marker as kind of a minimum safe zone.
Right.
Once you get past that, so most of these companies, when they're doing these 721 exchanges, they're going to hold for at least 2 years so that it doesn't look like they're flipping properties.
And so it's not a matter of the DST disposing, right? Like selling per se. It's more of it's 2 years and then that's kind of the period where people can transition from it, or is it actually the fund dissolves into the REIT?
It's the second one, exactly.
Okay.
So what happens is the DST property gets acquired by the REIT, but rather than the REIT paying cash, which would be taxable to everybody, what they do is they say, all right, we're going to absorb this DST property into our REIT, and we're going to pay everybody out in partnership units of the operating partnership of the REIT. And because of the way that's structured, it's not taxable. But then the owners of those operating units they have the right to cash flow and appreciation based on the performance of the REIT.
So, but when they go into it, they already know it's going to get acquired, or is it uncertain?
Kind of both. It's
Okay.
interesting. So,
Like, do you pick ones in particular for the client knowing that's the end game?
Yeah.
Or, okay.
yeah. So what happens is
So it's not a surprise, right? There's a plan in place when you do this.
Right. So when I'm working with clients and we're trying to decide which DSTs to invest in, one of the most important questions is, do you want to go through a 721 UPREIT process and end up in a REIT, or do you not? And if you do, then the DST was in many times a property of the REIT. They took it out of the REIT, turned it into a DST, let everybody invest in it, seasoned it for 2 years, and then they reabsorb it back into the REIT.
So it's almost like the inverse is happening in that process.
Yeah.
Okay. Yeah.
And so we know the exact REIT that they're going to go into. So a lot of our initial evaluation is going to be at the REIT level. We want to know, do you want to be in this REIT? Do you like the portfolio and the performance of the REIT? If you don't, then we don't want to go into that particular DST,
Right.
as an example.
Okay. And this just goes back to the consultative approach of understanding what's the goal right now, what's the kind of longer term big picture, what's important to you about this. Do we want it to go into an active bucket versus a passive bucket as far as the investment goes? And then lining that up based on those conversations to make sure, where we have a mesh.
Exactly. Exactly.
Perfect. Okay, so one of my questions would be, how does someone choose whether to, go for a straight DST opportunity versus looking at options for a DST to convert into a REIT?
Great. Yeah. So one of the characteristics of a straight DST is the exit strategy is that typically 5 to 10 years down the road, the DST is going to sell the property. And when they do that, all the investors get their money back, and they can do a 1031 exchange into another DST. They can do a 1031 exchange into a property they find with a real estate agent, or they can take the money and pay the taxes.
Which one thing I just want to point out, that's what is really nice about the DST option, is that you can put it into a DST and you can bring it back out.
Mm-hmm.
Whereas there's other vehicles where once you convert it, you can't bring it back out into brick and mortar. You're set in that position. And so it gives you at least an option, right? If you want to have it, or you want to bless a kid, right? One of your family members down the road with brick and mortar. But with a DST, the average ownership period is roughly what?
The average is 5 to 7 years.
5 to 7, okay.
Yeah.
And we've got, again, I know a lot of people may mention like, hey, I've heard of a DST, or I think my cousin did one back in 1995 and it didn't go well. This is different, right? We have a track record now. Large institutional investors that are playing a part in this. It's a different framework now, and it's obviously recognized in the code for the IRS.
Absolutely. And unlike the standard DST, what the UPREIT allows you to do is you go into that DST, it automatically converts into the REIT, and once it goes into the REIT, they never plan to sell that REIT and return funds to you. They plan to manage that in perpetuity. So what that means is you as the investor, after a certain time period has passed, have the potential ability to liquidate your interest in the REIT at the time of your choosing. And so if you've got $1 million in there and you want to take out $10,000 for Christmas or a trip or whatever, you can sell $10,000 worth of shares and get that out through their share repurchase plan.
I can kind of see now why someone would want to go the REIT route, because in the DST, they have to, right, they're going to dispose of that position at some point. You're going to have to reinvest, make another decision. So for the option for, right, the REIT, it allows you a chance to say, great, we can put that position in there and leave it in there indefinitely, so we don't have to feel like we have to check what's coming up next for reinvestment. Per se, right?
Well, it really depends on what somebody's investment objectives are. Typically, if I'm dealing with a younger person who has a lot of other rental properties, they really like that flexibility that when the property sells to go back into a piece of real estate. Typically, if I'm talking to somebody in their mid-70s or even 80s, they really don't want to do another 1031 exchange. They want to simplify and kind of set it and forget it. So they tend to be more attracted to the UPREIT strategy, so they can get in it, have diversification, and just not have to think about it again.
Yep, that makes sense. Okay, so as far as the actual, like, getting to the nitty-gritty, the process, right? Okay. So where do we start and where do we go from there?
So the process typically starts, a lot of times people will call me and say, hey, I'd like to exchange into a REIT, thinking that it's a one-step process.
Right.
So,
and then the education begins.
Yeah. And so we just kind of explain how it all works and explain how DSTs work. And what we'll usually do is evaluate the REIT options directly. So we might look at 2 or 3 or 4 different REITs. Find the REIT that best meets the investment objectives of the client, because they might only be in the DST for 2 years and they might be in the REIT for 20. So we'll evaluate the REIT. These are typically public companies, so they have public websites. We can look at the track record and the portfolio and the managers and all the things that we would want to know. So once we find a REIT that they're really comfortable with, then we look at the corresponding DST and say, well, if you want to get into that REIT, this is the DST that you have to hop into. So then we'll evaluate the merits of that DST and then ultimately do a 1031 exchange into that DST, which will eventually lead them into the REIT.
So when they're in the DST, right, they know it's going to be absorbed by the REIT, do they have to do anything else further, or is it already set up on the front end? Like, what happens after you're in that process of going from the DST to the REIT?
Yeah, it's very simple. The majority of the work, the vast majority, is the upfront, where you're doing the evaluation of the REIT and then of the DST. That's where all the paperwork is done. That's really where the heavy lifting is done. Approximately 2 years down the road, when the DST converts into the REIT, there's almost nothing for the client to do.
Okay.
They'll get a notification.
Which is good for people to hear, right?
Right.
We're really front-loading what you need to do in order to set yourself up for a lot of simplicity
down the road.
Ease down the road.
Yeah. There is a little bit of tax reporting. You have to tell the REIT what your basis is in the property, so you get that from your tax advisor.
Okay.
And the reason is because the REIT partnership is going to issue a K-1 and they have to know what your basis was.
Right.
So a quick email to your tax advisor to get your basis, and then you get that over to the DST, and that's usually about all you have to do.
And so I guess this is a good segue into, from a REIT function and the, tax implications and benefits of investing in it. You still get the, obviously, appreciation of
potential
of the shares, right? There's still a step up in basis, right? If you're holding it and you're to pass and your loved ones take over. So you're still getting the same ownership benefits of brick and mortar, but is there any differences? Do you get depreciation still, right?
Yeah, you do. Yeah, all the tax benefits remain. How they get accounted for changes a little bit. So when you go into the DST, at the end of the year, you're going to get a profit and loss statement. That's going to show all the revenue and all the expenses. The investor plugs that into their Schedule E directly, just like they did before they did the exchange. When it transfers from the DST to the REIT, The REIT, because it's technically a partnership of the REIT, issues a K1.
Okay.
So they're going to net out all the profit and loss and issue just the earnings on the K1. That's why they need to know what your basis is.
So you're going to reset your position, so to speak, when you go from the DST to the REIT, as far as, okay, here's where you were at when you started, here's where we're transferring over, as far as your basis.
The basis carries over. It'll stay the same. It's just that it gets netted out on the K1, whereas prior to the K1, you're putting it on your Schedule E.
Okay.
So this gets a little in the weeds for some individual investors,
Correct.
but the tax advisors, this is like, they deal with this every day, so it's
Okay.
pretty easy stuff.
Understood. Okay, now that we've kind of covered the groundwork for how the step-by-step process of getting into REIT ownership, what might be some of the disadvantages that someone might see or feel from considering a REIT?
Sure. Well, I mean, the big disadvantage for some people to going into the REIT structure is that you no longer can 1031 exchange it ever again. So if somebody's younger in their real estate career and they want that flexibility of taking that money and someday buying a plot of land or developing or something like that, you can't do that once you're in the REIT. Another disadvantage, just generally speaking, for some people is you don't have any control. I mean, I talk about the fact that you don't have all the burdens of property management. You also don't have the control of property management. So for some people, they're not really comfortable with giving all of that up. And then, of course, because this is turned into an investment and there's this army of people that are doing all these things for you, the fees can be quite a bit higher because of all those people doing all that work. They all have to get paid.
Yep. So, in short, really, for a DST and then heading into a REIT, it's, if you want to have other positions or you plan to be more active in the investment space from like a longer term horizon of 10, 20 years, this would not be a good fit for you, because then you're essentially at a dead end. And now if you want to get out of that position, there's a taxable event and you're out of the game, right? You're you're no longer preserving that. So that would be one. And then again, to recap, other disadvantages would be,
well, it's the lack of control, it's the lack of a 1031 exchange in the future, and the fees and expenses that go along with it.
And control, where someone's been used to maintaining their property for 30 or 40 years, so really it's the change of going from I do it to they do it. And I think what we want to focus on, though, is that what do I get? What's my return? Because if you got, all this team makes their fees, that's fine. All I want to know is what do I make, and if that makes sense, the opportunity makes sense, right?
So one of the things that we do with our clients is we'll do a quick analysis on their current property. We'll take their revenue minus their current expenses, which is easy, but then we'll do a little pro forma and say, if you own the property for the next 10 years, what do you expect the turnover and vacancy to be, and make-ready costs and leasing commissions and paint and wallpaper and carpet and all that stuff. And then we'll look at, if you own it for 10 years, are you going to have to address the roof or the HVAC or the hardscaping or whatever, and we'll back out all those guesstimates, because that's really what they are, into the future. And then we'll say, what does that look like in terms of net cash flow after you back out all those future expenses? And then we'll compare that to what does the DST market look like, and will your cash flow go down, stay the same, or even go up if you do the change?
I think what's important to take away from that is, with that analysis, because a lot of times, I'm talking to clients that have owned these properties for 20, 30, or 40 years, and they haven't really had pain, right? They've had fortunate as far as they've never had to replace the roof. They've never had to deal with the cast iron plumbing, a foundation, the things that you don't want to get a phone call for and says, hey, this is going to be a $20,000 fix. Do you have that available right now? And so that, I think, is a conversation that's not had enough of. We're talking about returns and cash flow. And so this analysis that you're able to put together really gets clear on what is the cost going to be over the next 10 years for these capital improvements, knowing that I've had a tremendous run with my, my rental property, but I also haven't had to do any of the major things. I haven't had to update the kitchens yet. I hadn't had to do the bathrooms. And you're kind of getting to a point where the next time it turns over, that's going to be what has to happen, right? So it's really, I guess, viewing it from the holistic, bigger picture approach of well, if I spend that, then what is my actual return on my money, right?
Yeah.
What kind of returns am I actually getting? And what we find is at that juncture, it could be a negative return
For
someone.
5 years.
Yeah, exactly. So it's like, if I could reposition this, have no money come out of my pocket,
Right.
and make a better return than my existing return, this is where it starts to make too much sense. To where it's a logical step that helps you get where you want to go and avoid having to spend money out of your pocket. Right? So,
yeah, that's the idea.
perfect. So what I'd like to do next is go through kind of the composition of a REIT. Like what type of REIT might there be available? What does it kind of look or feel like? What type of returns or expectations might someone have for a REIT? Maybe anything else that you might think is an important details about kind of the structure or just a visual of what a REIT would look like.
Sure. So I mean, they're all a little bit different, but a typical REIT is a public REIT. So Sarbanes-Oxley compliant with an independent board of directors. They file quarterly and annual reports with the SEC. Big public company.
Right. Okay.
They tend not to be traded on exchanges. So they're a public company, but they're not traded on an exchange. So you don't buy and sell them throughout the day.
Right.
When you want to sell your shares, you sell them back to the REIT through the share repurchase plan, sort of like a mutual fund does. You sell it back to them directly. They tend to be pretty large in size, usually 50, 100, maybe 200 properties, and they're very diversified. So it's not going to be all just apartments. It could be apartments and self-storage and student housing and senior living, industrial.
Do they have a certain percentage? Okay, this fund we're going to allocate 30% to industrial, 20% to multifamily. Is there a strategy within the different asset classes, or is it really just a compilation of different assets that?
No, they'll usually have an investment strategy posted on their website, and that strategy is typically diversification, but they'll weight them. So right now you're not seeing a whole lot of office in REITs.
Weird. I wonder why.
Right? And maybe 10 years from now there won't be a lot of apartments because they'll be out of favor, whatever. But they tend to still kind of have their chips across the board and diversify.
To these providers, is it okay? This provider is known for this, or do they have a certain brand as far as where they focus their investments in? Or
currently, and for the past several years, most of them, the strategy is just diversification. They're not trying to place the winning bet. They're trying to pick high quality assets in different parts of the country and different asset classes. So they're pretty diversified.
And really, it's kind of like if we analyze it by a portfolio or mutual fund of stocks, right? They're going to have small cap, mid cap, large cap, mature ones that are doing dividends, some that are not doing dividends. So bundling it together, you have a very solid infrastructure, so to speak, that's going to generate a very consistent, reliable return for you.
Yeah, that's their idea. Is if you look at their investment objectives on their website, it's typically capital preservation with stable income potential for modest growth, and they get that through investing in what they call core properties. So big, really high quality, usually pretty new properties in major markets. They're not taking a whole lot of risk in terms of where they're buying property and the type of property they're buying. They're typically stabilized properties with tenants are already paying rent.
Right.
So that gives kind of a client profile. The difference between one and another is usually not very extreme. They're pretty close to each other. Sometimes one will be leaning a little bit more toward yield, so they'll take a little bit more risk, while another one might be a little bit more conservative. But it's not like the difference between a blue chip stock and a startup technology stock.
Right.
You just don't have that kind of difference between them.
Because part of the whole benefit is it's something you can rely on for a consistent return, and it's rather stable.
Yeah, that's right.
Okay, makes sense. Now that Jason's gave us a general sense of what a REIT is comprised of, or what it might look like as far as the number of assets held, the way they function, I wanted to provide an active example of what a REIT is currently performing at, and just give you more of an understanding of the composition of it, right? What are the properties, where are they located, what are the return expectations, and really give you a good sense of kind of what it looks and feels like, knowing you can't go wrap your arms around it being 138 properties. So let's get into it real quick. First slide we're going to see here is just a quick recap of their business model offering, what they're achieving with their model here of creating a DST fund to bring it into a real estate investment trust. As you'll see, the fund was incepted or started in 2012, and the sponsor being Jones Lang LaSalle Incorporated. Make sure we give them credit. Their funds manage over $1 billion across 19 different DST offerings, which is to say they have an understanding of how to manage, place, and reinvest money through the DST into the REIT function. Lastly, they've completed a total of 10 complete UPREIT cycles, which basically means they have offered a DST, allowed investors to hold that for the required time of 2 years or greater, and then brought that investment into the real estate investment trust or fund. Next, we're going to look at the overall summary of the real estate investment trust. As we can see, there is 6.8 billion with a B total asset value, and 138 properties spread out across the US, 96% occupancy, which is strong considering we're located in different areas throughout the US, which we know not every location is performing at the same level of success or occupancy rate. Company leverage 39%, so they have 4.2 billion in equity and 2.6 in debt or leverage. And again, inception of 2012 for the fund. Next, we're going to look at the quick overview breakdown of what is in this fund. There's 138 properties, and as we can see here, this really gives us a good visual of what are those properties? What are they made up of? Well, overwhelmingly residential and industrial at this moment. If we could see here, they're 42% for residential, 32% for industrial. So that makes up a total of 74% of the 138 properties. Next, the geographic location. We'll see they're predominantly located in the west region and the south, with east trailing slightly behind and Midwest at the bottom with less than 10%. Lastly, the tenant diversification. So who are the tenants that anchor the properties that they hold? And as we can see, healthcare, transportation, warehouse, and consumer services make up the overwhelming amount of tenant distribution, which makes sense given those are all staples or ongoing services and goods that we're going to always need regardless of market conditions. Also want to mention you can find all this information on their website, which we placed there at the bottom of the page, as they've got all kinds of additional information, visuals, things you can click on. You can check out the properties they have within this. So it really gives you a good sense of what this looks and feels like on a real basis. Here we have the historical returns of the REIT, and this is net of fees. So after all fees have been paid out, to the fund, the managers, etc., your total net return, as we can see, which ranged anywhere from 22% in 1 year to last year being negative 9.2. If you take these years added up, the average annual net return was 7.53%, which is more than double or triple what we're seeing a lot of the properties perform out here in San Diego if you've held them for any length of time in excess of 10 years. Lastly, just wanted to provide a visual of how the fund has performed over the past 15 years relative to other investment classes. So if you look at stocks at 9.3%, 6% for private real estate, 4.2% for corporate bonds, 6.8% for public real estate, and 7 or less than 1%, 0.7% return for treasury bills. So as you can see, the fund is performing above what would be deemed very safe and conservative, but still performing slightly less than what might be deemed a little bit more risky. Okay, we've gone over a lot of great information today. I trust you've taken away some nuggets, learn more about whether or not this might be a fit for you now or down the road. And in recap, some of the benefits that we learned about of owning and exchanging into a REIT really would be retaining the same benefits of brick and mortar. Right? We get still the benefit of depreciation, market appreciation, a huge one, step up in basis to your heirs upon passing. And we get to diversify across multiple asset types, tenants, and locations. So a lot of opportunities within the real estate investment trust, and also acknowledging this serves some people, doesn't serve others. The question you have to ask yourself is, where are you at in the investment season? And are you looking for time and simplicity, or are you looking for greater returns? If you're of the latter, you're looking for simplicity. You're not looking for tenant calls. You're not looking for lost rents. You're not looking for surprises with a repair coming up. So if that's you and you're tired of dealing with tenants, toilets, and trash, you're looking for simplicity, do reach out to Jason. Find out if it might be a fit for you. And feel free to reach out to Jason to get a copy of his book, as he did write a book on how to retire from being a landlord. So you'll get a copy of this. He'll also be happy to put together a cash flow analysis if you're interested in learning more of the details of your current performance and how your property stacks up for your cash on cash return. Outside of that, Jason, thank you for your commitment of time on this call. And thank you, listeners. I trust you took away some golden nuggets, some ahas, and look forward to seeing you on our wealth call for May 2024. Till next time, take care.